part 2 to chapter 14. Here we're going to talk about IRAs, or individual retirement accounts. Now, you might ask, what is a 401k and can insurance agents sell these? And the answer is a 401k is an employer provided retirement vehicle. So insurance agents don't sell these because they're not sold to individual people. These 401ks are offered through your employer. And it can work. They're a tax-deferred vehicle like some IRAs. So what happens here is you get a job, your employer will offer you the chance to participate in their 401k. They'll take money out of your paycheck pre-tax, and then you get to choose from a host of mutual funds where that money gets invested. And you have certain limitations of how much funds the maximum funds you can invest tax-free each year. But these are products that we're not going to talk about 401ks or 403bs in this chapter because it's not something that an insurance agent would sell. But insurance companies and insurance agents and financial advisors can sell an IRA, which is an individual retirement account. And this is going to allow, while people are in their working years, it's going to allow workers with taxable compensation, meaning that they have a paycheck that's taxed, to make annual contributions to a retirement plan. And we're going to talk about some of the limits and some of the favorable tax setups. And there's really two basic types. There's the traditional IRA and the Roth IRA. So we're going to talk about those. Now, if you have a 401k, it may limit your ability to participate in an IRA. We'll talk more about that later. So let's talk about the traditional IRA. So in a traditional IRA, it's going to allow people who are currently working to take a tax deduction for part or all of their IRA contribution, depending on how you're making that contribution. So these retirement accounts you're going to accumulate income tax deferred, which means that how it works is, say you put $10,000 into an IRA. And what's great about the IRA rules is that even if it's the tax year is 2020 and it's currently January, February of 2021, you can still make contributions to the previous year. And this will lower, it's like a tax deduction. It will lower your taxable income on your taxes. Now, but the distributions, when you retire and you have a retirement age, the distributions will be taxed at your ordinary income level. Now, and also participants who have earned income during the year must be under the age of 70 and a half to participate. Now, let's go back to 2018. The maximum contribution is $5,500, or 100% of taxable compensation, whichever is less. Meaning that if you only make $3,000, then that's the maximum that you could put in is the $3,000. So it has to be from taxable compensation. So if you have no job and you had passive income, you couldn't use the IRA. So, but anyway, this $5,500 changes every year. So they generally do increase it. And I think for this may be up to $6,000 now. I'm not sure, but you should check every year. This is changing. And there are circumstances of what is allowable to take the deduction. So let's talk about some of the eligibility requirements. So if you want to establish a traditional tax-deductible IRA, the participant must have taxable compensation. Like I was saying before, you must have worked and earned money from a job. So wages, salaries, bonuses, commission, or if you're self-employed income, this is all would be counted towards money that you could use to invest in a IRA. What's not included is dividend income, pension, annuity income, Social Security, rental income. More of the passive incomes are not are not included as counting towards the IRA compensation. Now, a full deduction is allowed in two general situations. One, a worker who is not an active participant in an employee retirement plan. This is why in the previous slide I was talking about the 401k. So 401k, 403b is what we would call an employee retirement plan. So if you are an active participant in a 401k or 403b, you cannot make a fully deductible IRA contribution to the annual maximum limit. So the only exception is if your income is lower. Then there's certain rules. If your income is at a low rate, you might be able to participate in both. So if the worker is actively participating in, say, a 401k plan, the IRA contribution is fully or partially deductible if the modified adjustable growth income is below certain thresholds. And that changes every year too. It also depends if you're filing single, jointly, married. These all have different thresholds. So taxpayers with incomes that exceed the phase-out limits can contribute to non-deductible IRAs. So there are IRAs that you can contribute money to that are not tax deductible. But the biggest bang for your money is when you're able to invest in a tax deductible IRA because you get a tax benefit from that. So distributions from traditional IRAs before age 59 and a half are considered early withdrawals. So if you're younger than 59 and a half, if you take money out of your IRA, you're subject to a 10% penalty unless certain conditions apply that are set by the government, death, disability, things like this. By the way, the 403b and the 401k also have 10% penalties for early withdrawal as well. Now, distributions from traditional IRAs are treated as ordinary income. So a traditional IRA is what we'd call a tax-deferred IRA. So any non-deductible contributions are going to be received income tax-free. So if you made a non-deductible contribution, meaning you didn't take a tax deduction for it, those will be tax-free upon exit of the IRA. So there's a formula used to compute the taxable and non-taxable portions of each distribution, similar to what we did with the annuity, so that has to be kept track of. Now, for traditional IRAs, these can be established at a bank, a mutual fund company, a stockbroker firm, an issuer. So these can be IRAs have a huge flexibility of where they can be established. And they can be set up in either as an individual retirement account or as an individual retirement annuity. So you can build an IRA into an annuity. So the IRA contributions can be invested in just about a variety of instruments. So if you create an IRA in your brokerage account, you can buy any stock or mutual fund in that IRA. And then, of course, you have the IRA rollover, which is a tax-free distribution of cash from one retirement plan. It's deposited into another retirement plan. So say, for example, you have a 401k at your employer. You quit your employer. You can roll over your 401k into an IRA without paying any taxes. Okay. Now, later on, a different type of IRA was created called a Roth IRA, which is one that sort of works in reverse of a traditional IRA. So a traditional IRA, you put money in and get a tax deduction. With a Roth IRA, you put after-tax income into the Roth IRA. So you pay taxes first, like you pay taxes in your paycheck, and then the money that after you pay taxes, you can put into the Roth IRA. And the benefit is when you withdraw these funds, when you retire, they're tax-free. Whereas a traditional IRA, you have to pay taxes on any withdrawals upon retirement. So the Roth IRA is nice because you don't know what the tax rates will be when you retire. They could be very high, especially with all the excessive government outlay and deficits they've been running over the past 20 years. Taxes could be going up. So having a Roth IRA would shield you from those unknown tax issues of the future. Okay, so annual contributions to Roth IRA, of course, are not tax deductible. The investment income accumulates tax-free. So this is the growing part. So you may have contributed, say in your IRA over a lifetime, you contributed $40,000 that you paid taxes on. But the IRA grew into a $200,000 IRA, which means that when you take that money out of the IRA, you won't have to pay any taxes on those funds, on the interest and profits you gained on those funds. Contributions can be made after age 70 and a half. So the Roth IRA has, more generous income limits than the traditional, but the traditional can be converted into a Roth at any time. And that's something that typically a financial advisor would help you with. So if we're going to, let's consider this comparison. Oops. Okay. Let's consider this comparison of the two. I just have to adjust this. I want to adjust the, there we go. Just a little bit lower so we can see the whole screen. Okay. So here is the traditional IRA and the Roth IRA. So tax status. Traditional is tax deferred. Roth is tax-free distribution. So this means the money going in, you don't have to pay taxes on, but the money coming out, you will have to pay taxes on. Here, the money going into the Roth IRA, you're saving, you'll pay taxes on, but the money coming out, you will not pay taxes on. Eligibility, you have to have taxable compensation below an annual amount. So these annual amounts, these change. I'll go over them later. Have taxable compensation below a certain annual limit. That's, you can see the textbook. Okay, age limits, you have to be under 70 and a half. There's no age limit for the Roth. It can be used at any time, because if you're putting money in you already paid tax on, the government doesn't care how old you are when you do that. But they don't want you to start sheltering money tax-free after age 70. After age 70 and a half, they want to start collecting money, taxes on the money that you put in that was tax deferred. Okay, so contribution limits for 2019, the contribution limits are $6,000, and they move up to $7,000 if you're over 50, and it's the same for the Roth IRA. So the contribution limits are the same for both, and I don't believe that these change in 2020, but every year they can change, and it should be looked into. Okay, tax deduction for the IRA contribution. So for the traditional, it's fully deductible up to the annual contribution limit of $6,000. So but this is only if you're not participating in a 401k or an employer-based retirement plan. Because if you have an employer-based retirement plan, they want you to contribute there first, and they won't give you access to the IRA if you have, say, a 401k. But this also depends on your income level. So that could be different if you're a very low income level employee. Okay, tax on investment income. Investment income accumulates tax-free. It's the same for the Roth IRA. Tax on distributions. Distributions are taxed as ordinary income on the traditional. Now, for the Roth, distributions are tax-free. And that's the real benefit of the Roth, is that the money comes out and you don't pay tax on it. Penalty. So you get a 10% penalty for early withdrawals of 59.5 for the Roth traditional. For the Roth IRA, contributions can be withdrawn tax-free, but there's a 10% penalty on withdrawal of earnings before age 59.5. So here, if you withdraw the money early, you're going to be paying tax on that money plus a 10% penalty. Here, since you already paid tax on money, you don't have to pay tax again, you just pay the penalty. So the minimum distribution, distributions are required at age 70 and a half. Here, there's no minimum distributions. So that's a real benefit of that. Now, so this is look at some of the limitations here as far as income. So if you're what we call your modified AGI, adjusted growth income, is $63,000 or less, you can take the full deduction up to the amount of your contribution limit. If your modified AGI is less than $63,000, is more than $63,000 but less than $73,000, you can take a partial deduction for the traditional IRA. Now that's if you're filing single. If you're filing married, it goes up to a little bit more money. So this filing status of your taxes is going to determine what your contribution limits are on the traditional IRA. And of course, we went over the withdrawal penalties. Now, if you're filing as a like I said, as you're married, it's going to be different than you're single, but there are different income levels that you'll have to, these change every year, that it's sort of a sliding scale. The more you make, the less that you're going to be able to contribute into the IRA. So when you're talking, that's why it's important if you're talking to a client, you need to understand what is their income level, should be the first question. How much do they make? Second question is, do you work for a company that provides a 401k? If the answer is yes, and you make over a certain amount of money, you will not be able to contribute to a traditional IRA, but you can contribute to a Roth IRA. Up into the $6,000 limit for people under age 50 and the $7,000 limit for people over age 50, which is called a catch-up feature. So if you're over age 50, you get an extra $1,000 catch-up on the IRA. If you're in a 401k, you would move from, the 401k is more generous. So a 401k, you can shelter up to $19,500, I believe. And if you're over 50, the catch-up feature moves that to $26,500. So it's more generous. That's why it's more advantageous if you have a 401k to contribute the maximum to that. So the Roth IRA, or you could really contribute it at any time because you're putting in after-tax money. So that's really a benefit on the Roth. But there are some Roth contribution income limits. They're higher level than the traditional. So if you're married, if your modified adjusted growth income is below $189,000, you can contribute up to the maximum level. So if you're single, head of household, or married filing separately, and your adjusted gross income is less than $120,000, you can still contribute to the Roth IRA. So there are some income limits. If you're single and you're making over, $120,000 or actually $135,000, your access to the Roth will be cut off as well. So while you're young in college, you should put as much money into, I would say, into a traditional or a Roth IRA while you're allowed to contribute. Because once you start working for a job that's going to provide a 401k, even if you choose not to use the 401k, it's going to greatly limit access to these retirement vehicles. But like I had said earlier in the lecture, if you do choose to use a rollover, you can roll over your 401k into an IRA later in life. So that there's no limit on. You're allowed to do that. So if you have $100,000 in a 401k, you can completely roll that over into a traditional 401k without paying any penalties or tax, or even a Roth IRA, but then you would have to pay tax on your non-tax contributions into the 401k. So you have to really do the math to see if that works best for you. So I see the Roth IRA is really more suited to younger people before they start making a significant amount of money working for companies that provide 401ks. So there is a market for this for sure. And it's nice because if you start funding the IRA when you're younger, they have many, many years for this to grow. So I would say most IRAs the investment should be put into stock market and then just let it ride for 50 years, as an alternative retirement vehicle that you'd have in addition to your 401k, Social Security, and possibly annuity. Okay, so that's it for the part 2 of chapter 14. The next chapter that we'll be covering will be chapter 15, individual health insurance coverage. Okay, thank you for your time and take care.